Stevens presents Capital Thinking, the state of debt capital markets in the energy space. This conversation will dive into the current energy debt capital market landscape, capital allocation plans for 2021, trends in the private debt compared with public debt markets, and how energy firms are handling liability management in this new environment. Stevens investment banking experts Davidson Hall, Managing Director and Head of Debt Capital Markets, and Lance Gurley, Managing Director, Capital Solutions Group, are joined by David Lazarus, Managing Director, Commodities Strategic Transactions Group from Morgan Stanley, and Justin Moores, Managing Director from Munich Re-Reserve Risk Financing.
Good afternoon, everybody. I'm Davidson Hall, Managing Director with Stevens and Head of our Debt Capital Markets practice. Welcome to Capital Thinking, Energy Insights for Today's Market. This virtual thought leadership webinar series explores the challenges and opportunities affecting the energy industry. Stevens has a long history of serving this space. The firm has been principal investor in energy since 1952, and the Stevens Energy Investment Banking practice began in 2009. We have expertise in E&P, midstream, oil field services, as well as alternative and renewable energy. Our dedicated energy team, which now consists of 15 professionals, has completed 170 transactions to date, while providing unmatched investment banking service on M&A advisory, fairness opinions, public and private debt and equity offerings. My co-host today is Lance Gurley, Managing Director here at Stevens in our Capital Solutions Group. Lance, welcome.
Thanks, Davidson. For our first webinar topic of 2021, we're exploring the state of debt capital markets for energy issuers. Our discussion will dive into the current energy debt capital markets landscape, capital allocation plans for 2021, trends in private debt compared to public debt capital markets, and how firms are handling liability management in this new environment. This is a topic that energy companies and market participants are keenly focused on. And I think we're going to have a great conversation with our panelists today. With us today are David Lazarus, a Managing Director in the Commodities Strategic Transactions Group at Morgan Stanley. Welcome, David, and thank you for participating. And also joining, we have Justin Moores, a Managing Director at Munich Re. Justin, welcome and thank you.
Yeah, thank you for inviting me to participate in the panel today. Looking forward to the discussion.
Thank you, Lance and Davidson and the rest of the Stevens team for having me, and I'm excited to participate. Thank you.
Why don't we get going? Davidson, can you kick us off?
I'd be happy to. Thanks, Lance. Okay, Justin, we'll start off with you first with a debt capital markets question. Okay, despite the ongoing impact of the global coronavirus pandemic, prices for oil and gas both rebounded considerably in the 6 months through February 1st. In the case of WTI, crude oil went higher than many predicted during the summer of 2020. So how do you expect a recovery in oil and gas demand, both on a macro scale and specific to your portfolio, to play out in the next 6 to 12 months? Justin?
You know, as Munich Re anyway, as far as, our portfolio is concerned and the way that we structure our financings, really don't have to take a view on, forward oil and gas prices. Because we're such large consumers of hedging, we're generally more focused on on the curve and where we can lock in pricing, but it's certainly supportive of companies being able to take out existing debt, and you ought to see deal flow tick up accordingly, but certainly like seeing prices come back up to almost close to where they were prior to the COVID-19 issue. So it'll be a function, I think, of how quickly we can get everybody vaccinated and return to business as usual, as well as what our the producers outside of North America and how there's management of supply and demand, whether that stays intact. So far, so good, and we're certainly liking the direction.
Great, Justin. Thanks so much, David. Any follow-up comments on that one?
No, I would say I agree with Justin there. I think it's really virus dependent. Like there's good tailwinds in the market right now, but it's going to be dependent on vaccine rollout and what happens with variants and mutations. But the market's definitely constructive right now. I think the one thing I'd add, on the commodity price, what we're seeing for a lot of our products that's, kept values down is that deferred natural gas and deferred crude oil, while the front is up to sort of where we were before COVID started, the back end of the curve is still, a decent amount below where we were at this time last year. So, I think as markets and sort of participants get more confidence that, the vaccine rollout is working and that, mutations aren't going to derail us here, we'll start to see better deferred prices as well.
That's great points by both of you guys. Thanks so much. David, let's stick with you for a bit on another debt capital markets question. And this one has to do with RBLs. Can you shed some light on how the tightening of the reserve-based lending or RBL market has impacted the energy debt landscape? And to what extent will RBL tightening impact your business over the next year or so?
Yeah, absolutely. Well, I think as everyone's well aware, the RBL market is, I've heard some say dead. I think I'll use very wounded right now. While there are a couple new players coming to the space, it's still very limited capacity, and there are, players continuing to look to exit. So, amount of availability is definitely hurting the market. Also, standards continue to tighten. Now leverage, people are looking sub 2 times, even really wanting 1 times levered. PDP, PV10 advances of sort of 50% or less versus when there used to be 2/3 to 70% plus credit for non-producing. And also we see some people moving more towards or talk of looking at more PV15. And I think this is a major factor in depressing the A&D market is debt capital's just gotten more expensive. And I think we'll see that continue to play out, that, what people are willing to pay for assets with the lack of cheap RBL capital is going to be very different. And, I think the one last comment I'd add on it is that, my personal view is that this will continue, this will be prolonged in the RBL market. We're not going to see a bounce back with market recovery because I think we're going to see a change in loss given defaults that banks have to use here. That historically, RBLs were viewed as, you don't lose money on them. And if you do, it's sort of 90% plus recovery. We've now seen a number of situations play out that are very different than that, with recoveries as low as 10% on some of the more distressed RBLs. And, that's going to lead towards banks having to use higher loss given defaults in their underwriting, which will ultimately lead to needing higher applicable spreads and margins and less appetite from that.
Yeah, David, I tend to agree with you, generally seeing the same thing and have the general same sentiment as you. Justin, I'll pivot to you and give you the same question.
Yeah, I think Dave did a pretty good job of describing what's going on and characterizing the current landscape. But as far as so I'll just speak to I expect it to impact our business. It's certainly, I think, steering more prospective borrowers to seek out alternatives. So we're getting a lot more inquiries. Another thing is I think you've got a lot of RBLs that were put in place, say the 2016 through 2018 period that are going to be coming up for renewal. So, just the dearth of active banks looking to, take on new exposure. It seems like, you may have a problem there with those coming up for renewal.
Sticking with you for a second here, Justin, as we look at the energy landscape for 2021, what do you think are the biggest challenges, or what is the single biggest challenge? And then looking at it from a different perspective, what do you think is the biggest opportunity in 2021 on the energy landscape?
A big challenge right now, I think, is you've got a lot of existing facilities that were priced and sized at a time where you had a much more supportive commodity price environment. And we're largely beholden to the curve because that's where we can lock in pricing. And right now the backwardation is certainly not helping. It's just not constructive for pursuing refinancing transactions. We've seen that come up. A lot of those become more financeable. However, at the moment I see that just being a real challenge. There's just a lot of stuff out there that's over levered because it was done at a different time. And when prices come back to support a takeout, especially now with the higher cost of capital, the lack of depth in that bank market right now is is really challenging. But that also creates opportunity for, alternative lenders like Munich Re, to come in and try to provide a solution. Of course, with our structure, I mean, it's available to some, but not others, because you do have to have, really a financeable asset value there, for us to be able to be, supportive in that sense.
That's great. Thanks, Justin. Maybe just a quick word from you, David, just on that same point. Any major challenges, maybe the single biggest challenge you see on the energy lending landscape for 21, and then same on the opportunity, and then we'll turn it to Lance to continue on with some of the questions.
Yeah, I think following up on Justin's point about, available sources of capital here and sort of debt, available capital from banks and I think it's wider across just investor. While things have improved and are getting better, I think we need to see the A&D market come back and more transactions occur to build investor confidence in what is the real underlying values on assets that you're advancing against, and what are your LTVs, and I think as we see that come back, which I expect will over the coming year, you'll start to see a lot of more investors get comfortable with investing in the space. But in the meantime, before that comes back, as Justin said, it does create a lot of opportunity, especially in monetizing, existing producing streams that people can get comfortable with what those underlying values are right now.
I mean, another thing I might add there is, I think you've got a lot of producers that, it happened fairly abruptly, although the trend was already in place, but, woke up and then there was the usual suspects of where you would go to procure, first lien financing are no longer available or supportive. So, but then when you go out to look for, some kind of alternative, I mean, every one of them looks different. I mean, of course, our offering has quite a bit of structure to it, and you don't really have the uniformity in terms of financing structures on the debt side. So I think a lot of people are having to do some really dig in to try to understand the landscape and really be able to compare one against the next.
That's great. Thanks, guys. Appreciate the input and insight on that. Lance, I'll turn it to you.
Thanks, Davidson. Well, with that as the backdrop, guys, maybe we can get down to brass tacks about how each of you individually in your firms are thinking about allocating capital in 2021. So I guess my question would be, what are your group's plans for investments in the energy sector in 2021? And also, how is your target deal size or structure changed over the last year? What are the key inputs there too? Justin, we take that one?
Although we had a quiet sort of back half of 2020, I mean, we were actively out there seeking to deploy new capital. We were able to get an increase in our mandate over that time. So, we've got dry powder and are, eager to put it to work. And so I think there's going to be a lot of opportunity this year. It's, we've already seen just an uptick in inquiries, coming into the first of this year. So, like I said, we are actively looking for places to deploy it.
David, what do you think?
Yeah, so the first I'd say, obviously Morgan Stanley is a full service investment bank. We're very active across the spectrum in M&A, equity issuance, high yield issuance as that market's come back, which I think we're going to talk about a little more later. But within the commodities group that I sit within, we're the two things we're very focused on right now are, first off, utilizing our capital and balance sheet for hedging purposes, as we see, as Justin's mentioned a few times, the need for hedging here. We've also seen, while there's been a reduction in bank availability for RBLs, there's also been a reduction in bank availability for hedging lines and for those purposes. So we see a big opportunity this year, continuation on the 2020 opportunity of increasing our number of hedge counterparties. And then, along that lines, where we're primarily focused from a capital standpoint within the commodities group that I sit in, are on what we call PDP monetization strategies. So, everything running the gamut from securitizations to prepays.
Fair enough, but we agree. We're seeing a lot of the same trends in the market. And David, in that specific vein, is there a specific basin or commodity preference that your group is seeing now? Are you gas versus oil, heavy? How are you thinking about those PDP monetizations?
I think we're somewhat agnostic to product or basin, but the things that are important is it's got to be hedgeable. We've got to feel confidence that we can hedge the basis as well as the NYMEX or the underlying there. We're looking for stable producing assets, curves that we're very confident in, and then also diversification. So, we generally, are looking for 100, 200 minimum wellbores.
In that theme, Justin, David was talking about some of these, perhaps more outside the box structures of PDP monetization. Are you all focused on any of those outside the box structures, such as VPPs or even securitizations or other maybe non-traditional reservoir financing?
Our structure is really quite similar to the VPP, and we've looked at some of those, and I wouldn't say that it's necessarily outside of the mandate. However, what we've found is the depth in that market is really not there at the moment. And on the securitization side, I think that has some real potential. I know there's a lot of folks out there trying to sort of crack that code and open that market up. We are certainly looking closely at that as well. And because what that allows us to do is really leverage our underwriting as well as participate in larger financings, which right now, given prices have certainly come up, but you still have margins that are compressed in many cases. And so the ability to kind of upsize your ticket there is even reduced kind of the overhead drag is something that we're also looking at. But on the securitization side, what we see is maybe the largest challenge there, or at least I say what I see is the ability to hedge it, at the volume, to make an issue like that make sense just because of the friction cost. So, and I don't know that there's necessarily an elegant solution there, but it's certainly something that we're focused on.
Let's shift gears a little bit and talk about one of the oil and gas industry's favorite topics, which is the incredible focus on ESG coming from the marketplace. And it's been, I think, obvious to even the casual observer of the energy markets that ESG has become a really significant driving force in the way management teams and boards are responding to the capital markets. It's a real driver. To what extent will your business change the way you're allocating capital in response to these ESG pressures from the marketplace? Justin?
Yeah, certainly the ESG trend is not slowing down, and we're certainly trying to get in front of that. Munich Re was a signatory to the Paris Agreement, and there's certainly a focus on towards carbon neutrality. One of the things we've looked at is carbon sequestration, as well as we do have a commitment to kind of neutralize our portfolio. It was mentioned earlier whether there was a bias towards one product or another, and certainly gas is generally considered the greener of the two. So if we did have a commodity bias, it would be towards gas. But it's definitely something that we're focused on, and it's been an active part of our ongoing discussions coming into this year. So, but I think quantification as well is how it's I don't know if there's a standard of measure as to how you determine whether you've achieved neutrality, and where you place the carbon footprint in the value chain. So anyhow, that's it's definitely something that's in focus.
David, what do you think on the ESG front?
Yeah, I completely agree. It's a bigger part of the discussion than it's ever been. I think it's here to stay. As a firm, we've a very large renewables and alternative energy business, and are committed to the space. So we're also committed to working with producers who we see more amenable than ever to ways that they can make their business more carbon neutral. May not be possible, but more carbon friendly. And some of the things we've seen are from a competitor, attaching carbon offset credits to tankers of crude oil to make those ship deliveries carbon neutral. We've seen a good amount of focus in, what I'll call the green gas space of making sure that wellheads are not leaking methane, that, things are being done in the most carbon, friendly way possible. And even to the point where actually are working with an existing producer client of ours right now on, using its wind power to provide the electricity to power their wells and their production. So I think you'll see more and more of those types of things happening of, trying to make the space, more friendly from a carbon standpoint.
That makes total sense. And just a quick follow-up, to what extent is that ESG criteria starting to float into your investment consideration? Obviously, both of you have platforms that have a lot of flexibility to them and, pretty broad portfolios. Are you considering this actively as you're underwriting new deals?
Yeah, I think it's part of the consideration now. I think it's part of the consideration we're seeing across, the large majority of the investor base here as well. The question's coming up. It's definitely early days, but it's, as I said, it's more and more part of the discussion.
And I'd say for us, I mean, it's certainly part of the discussion. And, as I think David was describing, and, opportunities where you've got a renewable component, there can be a sort of a happy marriage between the two in a producing operation, an example which David described. But, I think one of the things that we're trying to assemble at the moment is, creating incentives for borrowers, that have, make strides on the ESG side. And, again, it gets back to the quantification and demonstration that you've, achieved your objective there, and, where do you set those targets? So I think that's kind of the phase that we're in now. And, as that comes together, I think it'll certainly be implemented in a more, tangible form.
That's great. Thanks, guys. Davidson, let me kick it back to you for some public versus private talk.
That's great. Thanks, Lance. And look, no question about it. ESG is here to stay. Can't overlook it. There's no question about that. So Justin, this one's for you. Let's pivot just a little bit to some private and public markets. The ease and the methods through which some of these energy firms have had access to the credit markets over the past several years has changed. How do you guys look at that, both from a private kind of illiquid market opportunity as well as kind of public credit opportunity set? And more specifically, let's think about it from a primary issue perspective as well as kind of a secondary market opportunity perspective.
Yeah, I think for us, we're really focused on the private credit side, and we're seeing, a healthy amount of opportunities coming out of that direction. The public markets certainly do influence, and generally, when the high yield is active, that really puts a ceiling on pricing, at least for us. And we're also largely buy and hold investors, so we also like to certainly leverage our underwriting resources. So we're really focused on new issues, and we see plenty to do there. So less focused, and really that's outside of mandate for us to participate in any of the secondary issues.
Thanks, Justin. David, speaking of the high yield market, let's pivot to the next question here. Justin mentioned that when the high yield market really gets going, it kind of puts a ceiling on his prices. One of the things I've noticed, and I think we've all noticed, is the CCC index is trading, kind of in the 6s, approaching 7. And December of 19, that same index, was 10.5+%. So, Justin, to your point about a ceiling being put on pricing, we're certainly seeing it in the high yield market. David, as you think about the high yield market, do you anticipate some of the trends we're seeing right now in the high yield market continuing throughout 2021?
Yeah, listen, I think energy high yield being, influenced positively by the wider risk on mentality across high yield, as I think we have high yield across the wider high yield market. spreads going under 4% for the first time ever. And you're definitely seeing as, energy deals are still offering a premium for yield. You're seeing more interest and seeing some more interest in the lower end of the market. I think, better quality is still more desired. It's still largely, names that are known to the market, not a lot of first-time issuers right now. And I think I think the trend will continue into 2021, assuming, as we talked about earlier, things don't get derailed across the wider economy with the, virus variants, vaccine rollout delays, things like that. But yeah, as we go through 2021, does high yield for, larger, especially public companies, existing prior issuers to the market continue to build? I think so, but I think we're also going to end up in a sort of haves and haves not market, and the smaller end, sort of sub $250 million type borrowers are going to still be, starved for capital and be looking for alternative products.
I'd say that's an important point. I mean, we observed a lot of that, I guess, just in recent periods where, those that can avail themselves to, that form of capital. I mean, it really makes it difficult for those that are privately funded in, competitive bid processes, at least on the, on the A&D side. So I agree that there is a bifurcation of the market that seems to be playing out. And, with respect to the haves and the have-nots, as David phrased it.
Yeah, one just thing I'd follow up on that is I think that's important, and a theme we've both talked about throughout here is that with the RBL market retrenching, those private borrowers that were too small for high yield access generally, while there was some private credit they used, they largely relied on the RBL market to fund their businesses. As the whole market, be it larger folks with high yield access or smaller without, move more and more towards permanent capital solutions, there still is a real gap and a need with smaller borrowers for those permanent solutions to replace RBLs.
Yeah, I agree with both of you guys, and I think just looking at the broader high yield market, I mean, a lot of those yields have recovered and contracted. Justin, I'll give you a little bit of a softball here. I mean, as you guys look at opportunities, whether public or private, I mean, given the contraction in the yields in the more liquid or public markets, where do you guys see the yield opportunities presenting, either in the public markets or in the private markets? My guess is it's got to be in the private market.
Yeah, I mean, I think certainly you're going to find, I guess, richer opportunities in the private market, for the reasons we've discussed. But I think for those that are kind of in that in between size range in terms of the amount of the issue, is where we are right now trying to be the most active and seem to be finding the most opportunity.
Yeah, David, same question for you guys. I imagine that the majority of the opportunity is gone in the public market, but for maybe the one-off, are you guys seeing the same kind of opportunity split, meaning probably more in the private markets than in the public?
I can't really speak to that as I focus on the private markets, but we're definitely seeing a lot of opportunities in private markets right now. And I think what I can say is, we're seeing investors that, we work with that 6 months ago were very focused on public markets now have more appetite to look at private market deals.
Okay, perfect. Thanks, guys. We'll tackle one more question here in this section. I'll turn it over to Lance. So, David, we're looking at the vaccine. We've got pent-up demand for travel. Clearly, there's a lot of capital coming out of the Fed and Washington. Is this influencing competition among financial companies in either public or private debt markets for energy sector business? I mean, how do you see competition changing, if at all?
I think we've, listen, versus 9 months ago when there was practically no appetite for the space, there's definitely been appetite that's come back. Investors are starting to look at the space again. Within that I think the biggest thing that drives people is obviously opportunity, where yields were, where returns are, but also gaining comfort as commodity prices recover, that, there's some stability built into the market and we're past the worst of it. And I think that'll continue through 21, barring, any change in the vaccine and virus path, as I'd mentioned before. So I don't think anything specific from competition changing, other than the more stability we get, or confidence in stability in commodity prices, the more investor demand that should come back to the space.
That's great. Thanks, David. Justin, care to pile on?
No, I mean, I would agree with what David said. I don't know that I have anything more to add. I think really what we need is to, if we can just hold the course, and provide that stability, and especially around sort of the longer term, views on commodity price and outlook. So
great. Okay, with that, I'll turn it over to you, Lance.
Let's take a pivot to what's been a hot topic and a big trend over the past few years, really, which is liability management in the energy industry. And maybe the place to start is where we left off earlier in the conversation about the tightening of the RBL market and the number of participants that are seeking to exit the market altogether. As a provider of term loan capital, otherwise, to these private borrowers, how is the RBL market, whether it's through redeterminations or outright maturities that are having difficulty rolling over, are they affecting your decisions as a portfolio manager with your borrowers that may be facing these issues? Justin, will you take it?
Yeah, it's certainly become more challenged. There's for those that have a situation that they need to address in the near term. Right now it's difficult to find even enough participants to fill out your syndicate. And we're seeing a lot of like I said, we're getting a lot of inquiries. Of course, our the pricing that or cost of capital that's available as a replacement right now is certainly going to come at a bit of a premium in just about every case. And the issue with the RBL was always, as you pointed out, the redetermination. And oftentimes they're not really fully hedged. I mean, there is a component of hedging, but it obviously it hasn't been enough to absorb some of the moves that have plagued the industry. So for those that have I guess it's a reasonable bogey on a takeout, I mean, I think you can find willing capital providers to step in and try to be supportive. But I don't really have a great answer for those that are in kind of an over-levered position, and have, especially those that have ongoing drilling requirements and need a source of capital. I think those probably get managed first, but for the rest, I mean, I think there is a way out that doesn't involve a court proceeding. And we've taken a look at several refis, and also even looked at some RBL portfolios. But again, given our pretty strict requirement for hedging, it's difficult to do that on an existing portfolio of RBL credits.
David, same question to you. How is the tightening of the RBL market affecting your view of your borrowers and ultimately your thought process of making new investments in the space?
Yeah, I think the first thing is, I think across the industry there's still, while people recognize that the RBL market is very tough right now, there's still a good amount of denial and or hope that it's going to come back. I'm personally skeptical, as I mentioned before, that it's going to come back in a material way in the next few years. And I think we'll really start to see that happen as renewals, as Justin mentioned, as renewals come up, and producers are unable to roll those facilities into new facilities. They're going to need alternative permanent capital solutions, and that's where we're spending most of our time. And the commodities group is working on those PDP monetization products, be it securitizations, VPPs, prepays, amortizing term loans, things of that nature that match it, that includes a, fully hedged for the life of the transaction and sort of fully amortizing over that, anywhere from 5 to 10 year period, but really, matching PDP declines, producing asset of financing or advancing against future production streams, which, I think there is a good amount of investor appetite for that right now. And I think we'll see a lot more of the RBL market get replaced with that, but it is more expensive and it is an amortizing product. And I think it's going to take time for the wider market to, really embrace and accept that that's the option versus the hope of the RBL market returning as it is. Listen, if RBLs are available, it's a much more producer friendly product. That market's just in a lot of trouble right now.
No, that's right. And it's fundamentally changed, as you point out. So as providers of capital like you and Justin continue to develop these alternative solutions, it's going to be really interesting to watch the way management teams and boards react to that market development. Maybe just further, David, on that same theme, as you noted earlier, the A&D market really fell off a cliff last year. There was essentially nothing trading. There was a really wide bid ask, obviously driven by pandemic volatility and where the commodity prices were. Do you foresee the return of an A&D market as a realistic input to 2021 as borrowers are thinking about A&D transactions and liability management?
Yeah, I think it's starting to come back. There's still a bid-ask spread here between where sellers are willing to sell and obviously where buyers are at. We're seeing some narrowing in that. I think where you're seeing is assets where there's upside that works and stuff to be drilled right now at these prices. I think we're seeing that come back first, which makes sense. Is that going to come back to where valuations were a couple years ago? Not this year, at some point probably, but it's going to take time. I think we're still seeing, of sort of assets that, don't have identifiable or drillable right now inventory. That stuff's going to continue to be under a lot more pressure. But I think we do see it getting better this year, and we've sort of already started to see that happen.
Justin, same question to you. Is A&D going to see a return to normalcy in 2021?
I mean, I think it has to at least to some degree. I mean, as David mentioned, you've certainly got, there's just a lot of price discovery going on. So, I mean, you've got the bid-ask spread, and then you've also got, kind of a paradigm shift in terms of, your financing sources and your borrowing costs. So, all of that has to be weighed, and hopefully, there will be a narrowing of that spread and the market will find some equilibrium. But, I think there's certainly those that need to sell, and, there's a lot that are, eager to seize the opportunity on the buy side.
So Justin, following up on that, there's been a really significant transfer of equity ownership in the energy market over the past 5 years. As you know, we've had a historical downturn that was preceded by a heck of a lot of funded debt on corporate borrower balance sheets. So it raises the million-dollar question for a lot of operators and management teams in the market that are looking to transact, looking to build their business and acquire assets. With so many unnatural owners in the E&P market, what is going to be the catalyst to get some of these restructured businesses to transact and start selling assets, making some moves?
Well, generally speaking, you talk about unnatural owners. I mean, there's a desire to exit as soon as possible, regardless of what your price you're able to fetch the market. But we've certainly seen some, and it's going to vary by fund and that and also within their mandate, but some have actually stayed in the position and held it. And I think as soon as we talked about earlier, you see some narrowing of the bid-ask spread, and you've got really a market clearing price that's been established, at least for the time being, that people can rely on and form an expectation. I think you'll see some of those start to transact. But I think the decision was made for them largely when we were, in the highly depressed, commodity price environment that we just, I guess, we're starting to come out of.
That makes sense. David, same question to you. Is there a key indicator from your standpoint about when you're going to see some of these unnatural owners look to exit their positions?
I don't know if I necessarily can think of a key indicator, but I do think it'll be quicker this time around than last time, as I think we were all across the industry caught by surprise here as to how short the recovery cycle was the last time, from the 16 lows to the 20 lows. So I think given the shorter cycles we're seeing, you'll have people looking to exit sooner than they might have in the past, especially on a recovery. That I think there'll be less, sort of riding it out versus we've seen in the past on the way up.
That's completely consistent with, I think, the way we're looking at it as well, guys. Well, this has been a wonderful discussion, and I've been given the task of winding us up. So I just, first and foremost, like to say thank you very much, David and Justin, for sharing your perspectives and giving the audience a bit of the insight into your approach and what's clearly been a challenging market, but may yet have some green shoots. So thank you very much for participating. For the audience, please feel free to check the Stephens website for the rest of our virtual thought leadership series. And again, we appreciate it. Have a great day.
For more critical insights from Stephens Investment Banking, or to learn more about working with us, please visit stephens.com or contact Stephens Investment Banking at stephens.com.